Okay, let's jump right into it. Today, we're taking a deep dive into the first quarter 2025 earnings call from CLA.
Right.
You send us the call transcript and related materials, and it definitely tells a story. A company facing some, well, significant headwinds in the quarter.
Yeah, you could really feel that on the call. Results came in below expectations, no doubt about it.
Driven by external factor, some internal pressures too, it seems. But management was keen to emphasize they're also highlighting areas of resilience and launching strategic actions.
Exactly. They acknowledged the tough reality, the challenging environment, but the focus quickly shifted to, what they can control, their response and what's next.
Right. Not making excuses, but pointing to specific pressures.
Precisely. Identifiable things that hit the quarter hard.
Okay, so let's start with the hard numbers then. What was the snapshot of those Q1 2025 results that fell short?
Okay, so top line. Consolidated sales were $614.2 million.
Okay.
And that figure was down 6.8% compared to last year.
Right, and below what they expected.
Yeah, critically, it missed their own prior expectations. They projected sales to be down, I think, between 5% and 6%. So that sales softness was a key factor right away.
And how did that, flow down to the bottom line?
Well, adjusted earnings per diluted share came in at 22 cents.
Also short.
Also short of expectations, yeah.
Oh.
And operating earnings were really pressured. That resulted in an operating margin of just 2% for the quarter.
2%. Wow. That's pretty thin. There were some serious pressures when you see a number like that.
Absolutely. Either on the cost side, revenue side, or probably both in this case.
So what were the main culprits driving that pressure then?
Well, several things. Gross margin, for one, declined by 150 basis points year over year. It settled at 45.4%.
Okay, 150 basis points, so that's a 1.5 percentage point drop. Pretty meaningful hit on profitability per sale.
It really is. And then there's SG&A.
Yes.
Selling, general, and administrative expenses.
Where the operating costs,
Yeah.
What happened there?
Well, the dollar amount was actually relatively flat compared to last year, around $266.5 million. But because sales declined, SG&A as a percentage of sales jumped significantly. It went up 300 basis points to 43.4%.
Ah, got it. So even though spending was flat, it took a much bigger bite out of every sales dollar because there were fewer dollars coming in.
Exactly. They had some offsets like lower marketing spend, but other things like investments in international higher depreciation costs.
Right.
It all added up when sales were down, made SG&A a heavier burden percentage-wise.
Okay, so lower gross margin and SG&A taking a bigger chunk. What about inventory? That often tells a story.
Yeah, inventory levels ended the quarter up 8.1% year over year, totaled $573.6 million.
Reflecting that sales softness, I guess.
That's right. Product came in based on forecast. Demand wasn't quite there, so inventory built up.
And cash flow. With lower profit and higher inventory.
Unsurprisingly, cash flow from operations was negative $5.7 million for the quarter.
So definitely not just a simple sales miss. You see these clear knock-on effects. Margins, expenses, inventory, cash flow. It all ties together.
It does. And management, to their credit, they were pretty specific about why things unfolded this way.
They didn't just blame the macro environment.
No, I mean, they acknowledged the weak sales trends, especially February being quite soft before improving a bit in March and April, and the lower growth margins overall. But they also detailed three specific costs, like line item impacts.
Okay, that's helpful. What were those three specific hits to profit?
First up was sourcing disruption and tariff escalation. After that executive order on tariffs in early April, they basically paused China production.
Right.
They had to cancel or relocate orders mid-cycle. That disruption, the costs tied to navigating it, it impacted gross margin by nearly $1.9 million in Q1, a direct quantifiable hit.
Wow. So tariffs had an immediate cost impact even before maybe the full effects are felt down the line. What was number two?
Higher inventory levels. We just talked about that buildup. It meant they needed additional markdown reserves.
Because they expect to sell it at a discount later.
Exactly. Sales softened late last year. Inventory flow couldn't adjust fast enough for some parts of the brand portfolio. It wasn't aged inventory, they clarified, but just higher levels than the year before. Required about $2.3 million in additional markdown reserves compared to last year.
Okay, so softer demand, excess inventory, a direct hit to profit this quarter via those reserves. Makes sense. And the third one?
This one was worsening customer credit issues. They saw expanding concerns about the financial health of some customers, presumably wholesale partners. And that meant they needed to add bad debt write-downs. This hit profit by almost $3.1 million compared to last year.
Oof. So let's see, $1.9 million from sourcing tariffs, $2.3 million from inventory reserves, $3.1 million from bad debt. That's over $7 million right there.
Yeah, over $7 million in specific identifiable costs that really pressured the quarter's profit. Gives you a much clearer picture than just, margins were down.
Absolutely. That detail really helps understand the drivers. Okay, let's shift gears a bit. How did the two main business segments perform within this environment? Let's start with the brand portfolio segment.
Sure. The brand portfolio segment, that includes brands like Sam Edelman, Naturalizer, Allen Edmonds, its sales declined 6.9% in the quarter.
Pretty much in line with the overall company decline then.
Yeah, pretty consistent across channels for the segment. But gross margin here was particularly pressured, down 280 basis points year over year.
Wow, even more than the overall company margin decline. Why was that?
Well, they pointed to lower product margins, those costs related to moving goods out of China we mentioned, and also those higher inventory reserves, which apparently hit this segment harder.
Got it. Were there any glimmers of positive news within the brand portfolio despite the overall dip?
Yes, actually. Management highlighted a couple of things. According to third-party data from Circana, the segment actually gained market share in women's fashion footwear.
Oh, interesting. So lower sales, but grabbing a bigger piece of the pie.
Seems like it. A positive signal. They also stressed that their 4 lead brands, Sam Edelman, Allen Edmonds, Naturalizer, and Bionic, were key.
How so?
Well, together, they represented about 60% of the segment's sales, but a whopping 80% of its operating earnings.
Okay.
And these 4 actually outperformed the rest of the brand portfolio during the quarter. So relative strength within the mix there.
Any specific bright spots for those lead brands? What about Sam Edelman?
Yeah, Sam Edelman actually delivered a solid quarter. Domestic sales grew and international growth was double digits. China specifically saw improvement, driven by sneakers and expansion into new marketplaces like the Middle East. Both wholesale and DTC grew for Sam Edelman.
Okay, that's good news. Naturalizer.
Naturalizer saw overall sales down, but it maintained market share. And interestingly, its website conversion rate improved by double digits.
So people visiting the site were more likely to buy.
Exactly. And they highlighted the success of their first shop-in-shop concept at Macy's Herald Square. It opened last fall.
How's that doing?
Apparently driving over a 50% sales increase in Q1 compared to the old layout. It's on track to be the brand's top location globally. So that's a tangible win they can point to.
Nice. And Allen Edmonds and Bionic? Any highlights there?
Allen Edmonds had a softer quarter demand-wise. Consumers were responding more to newness, casual styles, rubber soles, sneakers.
Yeah.
Less so the traditional leather dress shoes.
Makes sense. Reflects broader trends, maybe.
Could be. Retail trends were apparently hit by financial market volatility in April, though they've seen a bit of a rebound lately. They're still opening new Port Washington studio stores, which are outperforming, and planning more outlets, too.
Okay. And Bionic?
Bionic was down year over year, but that was mostly due to timing shifts in deliveries and a catalog drop. It performed slightly better than expected, actually. The walking category sales grew over 100%, driven by a campaign and new styles. Early results in sandals were also encouraging. And they announced Gabby Reese as their first wellness ambassador.
Okay, so definitely some specific bright spots and strategic initiatives within brand portfolio, even with the overall pressure. And they also talked about a planned acquisition, right? Stuart Weitzman.
Correct. The planned acquisition of Stuart Weitzman, they framed it as a strategic fit.
Why now, given the pressures?
Well, they cited its premium positioning. The belief is that the higher-end consumer is more resilient long-term, offers a different customer profile than their existing brands.
Interesting. Diversifying the customer base upwards.
Exactly. And they highlighted Stuart Weitzman's strong direct-to-consumer presence and international footprint as key advantages they want to lean into. They've even brought in an external firm to help with integration and find synergies, both within Stuart Weitzman and across the broader CLA portfolio.
And when is that supposed to happen?
Expected to close later this summer.
Okay, so adding a premium brand, citing customer resilience. Interesting contrast to the Q1 pressures. Let's switch over to the Famous Footwear segment. How did that side of the business do?
Famous Footwear, their big retail chain, also saw sales declines in Q1. Total sales down 6.3%. Comp sales, so stores open at least a year, were down 4.6%.
Okay. Similar pattern within the quarter, like February being weak?
Exactly the same. February was the weakest, low double-digit declines, but then it improved sequentially. March and April combined saw low single-digit declines. So the trajectory within the quarter was getting slightly less bad, you could say.
Was anything actually working well for Famous? Any bright spots?
E-commerce was one. Sales there were up 2.5%, so the online channel keeps growing.
Okay. What about margins at Famous?
Famous Footwear's gross margin declined by 80 basis points. Management put that down mainly to having more promotional days, especially in that weak February period, and also higher freight costs.
Partially offset by anything.
Yeah, partially offset by fewer clearance sales and apparently better margins on the clearance they did sell. They kept using their BuboGo buy one, get one promo during key periods too.
Which categories seem to hold up better within Famous?
Men's, kids, and accessories all outperformed the total Famous Footwear business. Women's underperformed. Athletics was also highlighted as strong.
They seem to talk a lot about kids, don't they?
They really do. They see it as a leadership position. Famous actually gained half a point of market share in shoe chains, specifically in the kids category. That helped Famous overall gain 0.2 points of share.
Wow. So kids is really driving share gains.
It seems to be. Kids penetration was 21% of Famous sales in Q1. And they noted kids sales have beaten the total chain's performance for 16 of the last 17 quarters. That really underscores that leadership position. They also mentioned their own brands sold in Famous, like Blowfish and Reka, did better than the rest of the assortment.
And they've been rolling out those Flair store remodels. What's the latest there?
Right, the Flair concept. At the end of Q1, they had 44 locations converted.
And are they working?
Management reported encouraging results, specifically an 8-point sales lift versus the rest of the chain for stores converted in the last year.
8 points is significant.
It is. And a 3-point lift for all Flair stores combined. They think Flair is helping them attract more elevated product and brands, and customers are responding well.
So, more planned.
Yes. They plan to continue the rollout. Added 2 more in Q2 already, 7 more planned by July. That'll bring the total to 53 Flair stores heading into the crucial back-to-school season.
Okay, that seems like a tangible investment paying off. And wasn't there also a major new brand launch announced for Famous?
Yes, a pretty big one for the chain. They launched the Jordan brand.
Jordan, wow. When and where?
Mid-May, in 147 stores initially. They're backing it with prominent signage, branded fixtures, full family displays, especially in those Flair stores, and targeted local marketing.
And how's it doing so far? Early days, I know, but...
They said early selling results have been very encouraging, especially in men's, boys, and accessories.
And that's just the start, right?
Exactly. This initial launch is just phase 1. The plan is a full rollout to all Famous Footwear doors for back to school, which they define as mid-July. That will be supported by a national marketing campaign.
Exclusive to Famous.
Currently exclusive to Famous Footwear within the shoe chain channel, yes. They feel pretty well positioned for back to school overall, actually. Mentioned expanded or new assortments from several key athletic and casual brands, too.
Okay, so despite the Q1 comp decline, Famous Footwear does seem to have these specific high-potential things going on. Flair, the Jordan launch. Management's clearly betting on those to drive performance, especially into the second half.
That's definitely the narrative they're presenting, highlighting these areas of strength and investment within Famous as key potential drivers to, offset some of the broader market pressures.
Okay, let's talk about management's overall response then to the challenging Q1 and their forward outlook. What concrete actions are they taking?
Well, they emphasize focusing intensely on controlling the variables they can actually manage. A big one is optimizing sourcing.
Getting out of China faster.
Significantly faster. They stated they expect only about 10% of their source dollars to come from China in the back half of the year. That's a huge reduction.
How are they mitigating the impact of tariffs and shifting production? That sounds costly and disruptive.
It is. Their strategy involves a few things. Working with factories for concessions, so getting better deals. Absorbing some costs through lower gross margins in the near term.
Taking a hit themselves.
For a bit, yeah. And implementing selective price increases. Those are starting with fall 1 receipts. But they stress that pricing will remain fluid as they navigate all this.
And didn't they also announce cost cuts? Structural one?
Yes, that was a key point. They're implementing structural expense cuts designed to reduce SG&A by $15 million on an annualized basis.
Okay. When do those savings kick in?
Expected to start flowing through in the third quarter of 2025. So they anticipate $7.5 million in savings in the second half of this year, spread evenly between Q3 and Q4. They framed it as a permanent reduction in their cost structure.
Right. Given all this change, tariffs, sourcing shifts, cost cuts, what do they say about guidance for the rest of the year?
Yeah, that was notable. They suspended full-year guidance. Basically, due to the continued uncertainty around tariffs, especially with those pauses potentially lapsing later this summer, and also the fluidity of the wholesale order book for the brand portfolio segment. As they rebalance sourcing and work with customers on new pricing, things are just too uncertain right now.
Makes sense. Need to stay nimble.
Well, that's what they said. Need to remain nimble to operate effectively in what could be different sourcing and market environments soon.
Did they give any color at all on how the current quarter, Q2, is shaping up so far?
They gave a little bit. For Famous Footwear, comp sales trends are apparently slightly better than the Q1 decline of negative 4.6%. So still negative, but maybe less so.
Okay. And brand portfolio?
In the brand portfolio segment, they've seen a modest increase in direct-to-consumer sales compared to last year. And DTC is about a third of that segment's sales.
But the wholesale side?
That's the caveat. They reiterated that the larger domestic wholesale order book for brand portfolio remains fluid. That's still a key area of uncertainty for that segment's near-term performance.
Okay, so the picture management is painting is challenging Q1, hit by specific quantifiable headwinds. But they're actively responding. Cost cuts, sourcing shifts, pricing actions.
Right. And pointing to specific growth drivers, especially in Famous Footwear, plus the potential strategic benefits from Stuart Weitzman as the keys to navigating this and building for the future.
So for someone listening, trying to make sense of all this, what are the key takeaways they should be thinking about as an investor?
Okay, first, just acknowledge Q1 was tough. The miss was driven by that mix of external factors, tariffs, sourcing disruption, and some internal or execution challenges like the inventory misalignment and those customer credit issues. These weren't small things, they were material impacts.
Right, but the second takeaway is management's response.
Exactly. Management isn't just sitting there, they're taking specific actions. The $50 million annualized cost cuts, the big shift out of China sourcing, the selective price increases, these are tangible steps.
How should investors think about the two segments differently based on this call?
Well, the brand portfolio segment clearly faces more near-term headwinds. Sales, gross margins were pressured. Management mentioned continuously reviewing the portfolio.
But there are bright spots, too.
Yeah, within that segment, you have Sam Edelman's international and DTC growth, Naturalizer's Macy's shop-in-shop success, and better online conversion, and then the planned Stuart Weitzman deal targeting that higher-end consumer. So it's a bit of a mixed bag. Overall challenges, but some promising individual parts.
And Famous Footwear.
Famous Footwear, in contrast, seems positioned as maybe more stable, with clearer, identifiable, near-term growth drivers.
Like the kids' business and Flair stores.
Right. Leadership in kids gaining share, Flair stores showing a demonstrable sales lift, and then that upcoming nationwide Jordan rollout for back to school. That's a big, tangible catalyst. Famously seems like it could potentially provide a more solid floor for the company's overall performance right now.
But there's still that elephant in the room, the suspended guidance.
Absolutely. The fluid tariff situation, the uncertainty in the brand portfolio, wholesale orders, it introduces a notable degree of uncertainty near term. Suspending guidance reflects that. Investors will also want to keep an eye on those higher inventory levels and borrowings on the balance sheet. Those need to improve.
Okay, this brings us to our not financial advice segment. Based purely on everything we just discussed, the challenges, the responses, the segments, let's brainstorm a couple of speculative, maybe slightly outrageous trade ideas. And let me stress again, this is just brainstorming based on the call. Highly speculative, absolutely not financial advice. You must do your own research.
Yes, purely an intellectual exercise, exploring angles based on what management highlighted or the challenges they disclosed. Nothing more.
Okay, idea one. The market's obviously focused on the Q1 miss, the tariffs, the pressure, but they are acquiring Stuart Weitzman later this summer. Is there an angle there?
Okay, so the pitch could be something like, go long CLA, specifically ahead of the Stuart Weitzman deal closing.
What's the outrageous part?
The outrageous element is you're betting heavily on integration success and the resilience of the luxury consumer, while the core business is explicitly struggling with macro and execution issues right now.
Right.
Management mentioned bringing in help for integration and synergies. So the idea is maybe the market's so fixated on the Q1 pain, it's underappreciating the value. Stuart Weitzman adds its DTC strength, international presence, access to that higher-end customer. Closing the deal successfully could be a catalyst, showing they can execute strategically despite the current mess.
Okay, betting on a future acquisition, offsetting current pain. Interesting. What's another angle, maybe more focused on the segments themselves?
How about this? Consider a long position in CLA based primarily on the strength and upcoming catalysts identified within the famous footwear segment.
Focusing just on famous.
Yeah. And maybe, to make it more pointed, you pair this long with a short on a footwear retailer that doesn't have similar specific growth drivers, like strong kids momentum or a major new brand launch like Jordan.
And the outrageous part there
is that you're essentially isolating the thesis to one half of the company. You're kind of ignoring or downplaying the brand portfolio's struggles to justify the trade on the parent company.
So you're zeroing in on famous because management highlighted its resilience, the kids' share gains, the Flair store lift, and especially that big tangible catalyst, the nationwide Jordan launch for back to school coming mid-July.
Precisely. The pitch is that the Jordan launch, which they said had encouraging early results and will get national marketing, could be a much bigger comp driver for Q3 famous footwear performance than the market anticipates, given the overall gloom from Q1. It's a catalyst play on a specific initiative within the segment management presented as more stable.
Okay, fascinating ideas. But let me say it one more time. These are highly speculative, for discussion only, based only on interpreting points from this earnings call. Do not take them as financial advice. Please do your own thorough research.
Absolutely. Please do.
So pulling it all together then, CLA's first quarter of 2025, undoubtedly challenging. Marked by that miss, driven by specific, identifiable headwinds. Tariffs, inventory, credit issues.
Yep. But management is laying out a clear plan. Swift strategic actions, cost cuts, accelerated sourcing shifts, careful pricing adjustments, all aimed at addressing those headwinds directly.
And positioning the company for, hopefully, a better future. They're pointing to key strengths, key investments, particularly within famous footwear Flair stores, the big Jordan launch coming up.
And alongside that, the strategic rationale for adding Stuart Weitzman to the portfolio. It's a story of navigating a tough, uncertain period by focusing on control and highlighting specific areas where they think they can win.
We've walked through the results, the drivers, segment performance, management's response, and some potential investor implications.
Hopefully this deep dive into the earnings call content has given you, the listener, a clear understanding of the current situation at CLA and the strategic path management is trying to chart.
And remember, this was our analysis of the content presented in the earnings call. It is not financial advice. We strongly encourage you to review the source materials yourself and incorporate the points we've discussed into your own analysis.
Thanks for joining us for this deep dive.
And maybe consider this. Given the impact of those 3 specific quantifiable costs on Q1 profit, the sourcing, inventory reserves, bad debt, how much of CLA's future performance hinges on simply preventing similar issues from happening again versus how much relies on the success of new growth drivers like Jordan and Stuart Weitzman? Something to mull over. We'd love to hear your thoughts or what other calls you'd like us to dive into next. Until then.